All right, well, hello again, everyone, and welcome to the Master the Market webinar with Scott O'Neill. Today we've got a very special presentation because we've got a very special guest. Bill O'Neill, founder of MarketSmith and Investors Business Daily, will be joining us today to give us his thoughts on the current market and also today's topics, which happen to be holding stocks with conviction and how to handle volatility, two very timely subjects. Before we jump into the program, a couple of quick housekeeping items to address. Number one is this webinar is an interactive program. We do encourage your questions, so if at any point you do have questions purposes,
where you've got your red arrow,
buy or sell recommendation, they're just brought forth for educational and demonstrative purposes only. So with that being said, let's go ahead and jump into the program. We want to have, first we're going to talk about the current market. So Scott, why don't you jump in here and kick us off with a discussion of what we're seeing here in the current market.
Hi everyone. We're just going to talk a little bit about the current market. I want to welcome Bill again, our master MarketSmith. Bill, got a weekly chart in front of us. What are some thoughts on where we are and where we've been for the year? Well, very early on, where you've got your red arrow, you came out of a perfect little basing area and you had two or three base on base on base, and that has some meaning. And of course, you might notice after that arrow that every week for 5 or 6 weeks closed exactly at the peak. And it seemed to be inching up and inching up and inching up. That is institutional accumulation. They're not out there trying to blast away in the market and let everybody know what they're doing. But when you see these inching up things and closing at the peak, usually you've got a lot of institutions in there buying, and it takes them weeks to accumulate a size positions they might want. In other words, if they've got $2 billion and they want a 2% position, they've got to be buying a stock for several weeks. And that the fact that you had 1, 2, 3, 4, 5, 6 weeks in a row kind of tells you, hey, we're probably in a pretty strong market and this is going to go a good bit higher. Okay. Flip over to the daily, please. All right, so we have 3 distribution days, and we're up 30% on the year, so that confirms we're in a bull market. Any thoughts on 3 distribution days? I don't worry too much about 3. But when I get to 5, I start paying attention, and depending on what stocks I've got, I might cut back 1 or 2. And then, of course, when you get to 6, that's even worse. So in most cases, you're going to go into some kind of a correction. You don't know exactly how much the correction, so a lot depends on which stocks you've got and how much you're ahead and how things are working as to what you would sell and how much you might cut back once you get around the 5 or 6 area. 5, you might cut back 1 stock, and 6, maybe you have to cut back 2 or 3, depending on how they're handling themselves. Right, and of course how deep you are in the market too. Okay, so that's the NASDAQ. Let's flip to a quick check of the S&P, probably the same points. Yeah, basically the market is handling itself well. In the fact that you get 3 distribution days is not something to worry about. You're going to get some along the way. But when you get to 5, then you have to stop and think a little bit. And when you get to 6, then you've got to start, you want to get off margin and you start protecting yourself a little bit. And typically in these current week and the previous 4, how we came up strong with 2 weeks and then we got very tight and just kind of were sitting there, relatively speaking. That's typically a bullish picture? Yes, that's right. And notice the details sometimes count. The first 3 weeks up close at the absolute peak for the week. And that's telling you that it's pretty constructive. You saw a little bit of this on the coming up off the bottom several months earlier too. So put your arrow right there, Rich. That's what he's. Go ahead. Sorry. So you pay attention to where it closes within the week. Okay, and a quick shot of the daily where we have 2 distribution days. So really we have not accumulated very much distribution, and we seem to be holding fairly well up in this area. Well, I think when you're advancing, you're going to get some distribution. So I don't pay much attention to 1, 2, or 3 days. But when I get to 5, now I have to stop and think. I can say, well, maybe if a couple of days from now we get a 6th one. So when you get to 5, I might peel back something.
Just a little bit.
Well, be aware, but I'm not concerned about 1, 2, or 3.
Okay. And so then we always look at the groups real quick. The first group is very small, but there are a lot of interesting groups here. Oil and gas, there's quite a few interesting stocks. There's some biotechs. Internet content is in the news quite a bit, and that group's doing well. And you go right down the line. Now this is the top 20. Really, in a way, don't you typically look at the top 40 roughly?
Well, yes.
In any given uptrend.
40 out of how many?
197.
Okay. Well, yeah, most of your performance is going to come in the top quartile, and you don't want to be in a lot of the groups that are really lagging. Although I don't spend quite that much time with groups, I think you need a general understanding historically that you in every bull market, usually there's 1 or 2 medical stocks that do well. You know that leisure and entertainment is something that is important, and you usually have a couple of big leaders come out in that, a Netflix or whatever. So if you have some understanding of groups, and you know that building is highly cyclical, and maybe after you've come through a bear market and you turn, it might have a run-up. So each group has its own characteristics. And you just need to be aware of that. And the one thing I would warn people about is don't get all carried away and say, oh, wow, man, I really believe this group. And so you have 35, 40% of your money in that group. And what do you do if you're wrong? And you got 4 or 5 stocks, and all of them come down. So I don't tend to play groups. I tend to invest in individual companies. And even a group like medical and biomedical, I would want the leader in that group. I don't want to have 3 or 4 stocks in the group normally.
Okay. Okay, it comes down to individual stock selection. So let's get in. Oh, one last point I wanted to get into. Just tap your thinking a little bit. Fourth quarter, I mean, I remember over the dinner table several times you said, well, typically, the fourth quarter is the strongest. How do you compare, I mean, and again, very broad and general, fourth quarter versus first quarter versus summer?
Well, first quarter is a little more of a tossing the coin thing. I always kind of don't like January as much because you don't know for sure whether you're going to have a big strong year or where it's going to be weak. And you can't tell almost until the end of January. In other words, it could be rallying for the first 3 weeks, and then at the end of January it rolls over and tops. And a lot of your corrections started in January, and your second largest one of beginning corrections would be April. So it's a little tricky at that time, but that's the way it works. And a lot of bear markets wind up bottoming out by the fourth quarter in October, and so sometimes November and December come on fairly strong.
And summers, the reason I'm bringing this up for everyone is be very careful of the mantra from Wall Street, for instance, sell in May and go away, or it's always tough in January. For instance, in this year and last year, first quarter was pretty good. And then if you look at summers, we had a bad summer in 2010 and 11, but we had a pretty good summer in 09 and a good one in 2013. And so can you just talk about how you're much more in the moment and you're not trying to predict or project?
Well, the thing I do with the general market is very simple. I follow very closely the day-to-day market averages, the NASDAQ, S&P, whatever, and I make my decisions by the market itself. Is it starting to act very difficult, and I've got a large number of distribution days, and it breaks down and undercuts maybe a moving average and closes the week on huge volume. There are all kinds of little characteristics, but what I'm trying to say is I look at the market averages themselves as the thing that will lead me to decide, uh-oh, things are not acting so right. And I don't want to have some opinion based on the economic news. Oh, the economy is going to get better, or the economy is going to get worse, or so-and-so thinks this or that. Just look at the market itself and learn to interpret it and know where you stand in that market. Are you in the first year of a bull market, or the second year, or is this the third or fourth year?
And are your stocks acting well? You know, I remember years ago you said to me one time, because I was questioning you about the market, how it would open the next day or how it would be, because we had so many previous days where we're tough. And you smiled and said to me, I wake up not knowing what the market's going to do. And I sit down and then I watch.
Well, I don't remember that. That was probably quite a ways back. But the basic thing of that is you don't have a lot of personal opinions. Oh, I think the market's going down, or I think it's going up, because opinions aren't worth much. But you interpret what is it actually doing right now and in the recent past.
Okay, thanks.
And you bend with it. If it's not acting so well, maybe you back away a little bit.
And if it's acting well, you push forward a little bit. So it's at the moment sort of thing. So let's get into our topic of today. Holding stocks with conviction. Okay, we all go through this. Should we sell now and lock down a gain? Should we hold for a bigger move? How do we decide if this stock is an A-rated stock or a B stock? Let's look at our first. Okay, planning ahead. Watch list management. Okay. I remember, again, years and years ago, you talked about, look, you have to determine how many stocks you can own, keep track of, understand and know in and out, thus what's your comfort zone to stay on top of it. You want to comment on that?
Well, I think this game, so to speak, you start at the beginning of it and say, okay, I've got so much money that I'm investing, whether it's only $1,000 or whether it's $10,000 or whether it's $1 million. And you decide, how many stocks am I going to buy? And what's my limit? In other words, I may buy up to 10 stocks, or I may only buy up to 8, or I may buy up to 12. But decide on that in the beginning and try as much as possible to start each buy decision with the same dollar amount. Otherwise, what will happen is maybe one you buy $10,000 worth, and another one you start with $2,000. Well, what do you do if the one you started with turns out to be your big winner? You started in a real kind of scared fashion, and you probably never totally capitalize on it. So I try to start with the same amount on each initial position, and if it goes up 2 or 3%, I automatically follow up with a lesser amount, but I want to wind up having more money in the ones that work and are right, and less money in the ones that aren't working.
Yes, let's back up one, the watch list management. That's simply assuming that you always have a fresh watch list. You never want to get caught flat-footed. Always have a fresh list of stock ideas, and of course you can run screens in MarketSmith, and IBD provides ideas. There's no shortage of coming up with ideas, but that watch list always has to be fresh. And then, as Bill is saying, we want to have an idea. If it's, for instance, for me, I'm probably in my comfort zone around 12 stocks, roughly. And then let's talk about group diversification. You were just talking about you never own a group. You own individual stocks, and you don't want to be too heavy in a particular group because you can get out of balance if that group gets hit. Any other comments on that one?
Well, I think that, many years ago I might have looked at it with, I think the electronics group is strong, and so I'm going to have 30-40% in that. And I think that's risky because you're buying individual stocks, and I want to buy the very best stock in a group. And I may have 5, 6, 7, 8 different groups. So I don't like the idea of investing of, oh, I think semiconductors are going to do great, and here this one I've got is terrific, and I'm going to buy a few more, and I'm going to have 25, 35% in it. I just don't like that, because now you're making decisions based on industries.
Based on a theme.
Yeah, and I think you want the best stock in a group. And what is the best stock? Well, the one with the biggest earnings and the biggest sales, and the price and volume action is showing that it's actually doing what you think it ought to be doing, not that you're hoping that it's going to do something.
And, of course, strong proprietary rankings. We have a lot of those.
Yeah, you want the sales to be there, and you want a return on equity. I don't want to buy something with a poor return on equity.
Right, right. In fact, we're going to get to that point in just a moment, too. So let's talk about now starting right. Proper identification of price consolidations on the chart. There is a spot on the chart that it has your lowest risk and highest probability of success. And we, as MarketSmiths, we must be able to identify that spot on the chart. Now, we don't have time today to go through a lot of patterns, but we'll go through very quickly. Bill, would you just talk about the cup and handle?
Well, this is your classic pattern. You see more of these. And what we find, a typical pattern will correct 5 to 7 weeks on the left-hand side going down. And it'll probably be contained within 15, 20, maybe 25% if you're in a market correction. And then it starts going up, and it should get to within 5 or 10% of the absolute prior high, and then start backing away and build a little handle. In other words, you need to adjust a little bit from the very bottom up to that peak. You've run up a lot, and you need to pull back. And it doesn't make any difference whether the handle, which I call that short period, is down 8 or 10% or 10 or 15 if you're having a market that's rougher and tougher. And it can last 1 week or 2 weeks or 3 or 4 or 5. But when it comes out of it, the volume should come into it. And this is a classic pattern. So you want to learn to recognize that pattern, because what you should be doing is every weekend going through a whole bunch of charts looking for these patterns. And I can think of all sorts of stocks. Apple is a great one, that I saw the first cup with a handle that it was being formed, and I looked at it, and it was almost a perfect cup with a handle. And the reason I was looking at it is the prior record for the prior 2 or 3 years had been very poor. But they had turned, and they were showing a quarter up strong, and the pattern was there. So you can come up with the next big name just by the pattern recognition. Now, what you have to do, once you recognize, wow, this looks like a classic cup with a handle, now you got to do your homework. Are the sales there? Are they increasing? Is the earning power increasing? Does it have any sponsorship that's decent at all? You go through and try to figure out, well, what are they doing that's different now than before? And maybe they've got a new product that's really selling. So you don't buy just because, boy, this pattern is there. You buy because, boy, this pattern is there, and it has good earnings and good sales, and I understand what I'm doing. So you want all these things together.
And you once told me that, it's kind of an interesting point, that these are the patterns of accumulation. Let's talk about that for a second.
Well, a stock's going to correct at some point, and it can, if it corrects 10, 15, 20, 25%, depending on what the market's doing, that can be a normal correction of 5 to 7 weeks. Then it should rally back up. And if it is a sound, strong stock, it should rally back up into the upper part of the pattern and then build a little handle. So it would probably stop maybe 5% away from the old high and then build a handle. Now, if it has that correction and starts running up, but it does its work in the lower half of that pattern, it might get away with it a little bit later, but that is a sign of not being as strong and powerful. In other words, after you've corrected it, in this instance, for 1, 2, 3, 4, 4.5 weeks or whatever, it bounces strong and it gets into the upper half fairly quick. So I call that a prior uptrend, And you want to see that, and you want to see a little bit of volume. Then it builds its handle, and the handle should dry up in volume. You don't want to see big volume on down weeks in the handle. And then when it breaks out, you should get the volume. So you not only recognize the pattern, but you understand how to look at the volume that's occurring at different key points. Okay, and this happens to be something you will remember. Actually, you and I both owned this back then, and I remember it looking so perfect that I was worried that the whole world would know, because it was such a perfect cup. Well, you don't have to worry about that, because first of all, most people that invest don't do very well because they invest by, oh, I like this stock, I think it's a good stock, and then they buy it, and if it doesn't work, they sit with it. Well, it's a good stock, and I know it'll come back, and they do all kinds of crazy things based on how they feel or what they think. Basically, in the market, what you think isn't worth much. You've got to interpret what's actually happening and understand it, and most people have trouble, and that's a lot of work, you know, and everybody doesn't want a lot of work. They just want to say, hey, tell me what to buy. Right, and then they have no clue on selling, and that's why it's so important to learn how to catch fish on your own. Do this on your own. It can be incredibly rewarding. Well, that brings up one point that maybe we want to talk about it later, but you are going to make mistakes, and when you make them, you want to cut them as quick as you can. I've said arbitrarily that I don't want to lose ever more than 8%, so if it's down 8% from what I paid for it, out it goes. I won't even wait for 8% in most cases. Now, maybe you might say if it goes down 4 or 5% from what you paid for it, not off the peak, but from what you paid for it, you might sell half, and if it goes down to where it's now down 7% or 8%, you could sell the rest. So, but just cut them short so that your losses are all short, and you make some 20% gains, and every once in a while you make a 50 or 100% gain. See, that's a good point you're bringing up. We actually don't always wait for 7, 8% because we see that it's not acting the way we thought it should act. It's acting a little strange, and so we start backing away. And that's just plain experience of knowing how they should act at certain points on the chart, right? Well, now that's a key issue, and I can tell you another thing about what experience will show you. You're going to buy stocks. Let's say over a year you buy 10 or 15 stocks. Well, of the 10 stocks, what if you're wrong on 5 or only wrong on 3 or 4? You got to cut out of them now. And I don't think people operate this way. Now, there is a concept here that forces you into the point of where you rarely ever are going to have 8% losses, if we say that's the limit. For example, that you're buying a stock and the first stock works and the second stock doesn't. So, and now you buy a third stock and it works, and then the fourth stock doesn't. So now you bought 4 or 5 stocks, and one of them is really working great, and it breaks out and holds tight or pulls back to a moving average line that's right, and you've got a chance. First of all, if it's right and it goes up 2.5%, you automatically add some. Right. On your second buy, it ought to be automatic. Pyramiding into position. Yeah. So as I'm getting a couple of things that are working, I'm buying something. Well, where am I getting the money? I'm usually selling it from my weakest stock. So after a while, by doing that, I rarely ever would have a stock down 8% because I sold it when it was down 3% because I needed the money to follow up on one that was working, and I had to get the money from somewhere. So I'm always selling my weakest, and I think it's maybe once or twice a year I might have a 7 or 8% loss. You know, it's funny, deja vu. I can remember years ago as a kid, you kept harping on me, look, just master the system. The system will force you where you should be, not just in respect to the market, that was one, but also on this point, portfolio management, pushing more money into what's working and pulling money out of what is not working or is too slow. And you kept saying, look, just master the system. It will guide you. Yeah, it kind of forces you. And that's why my second buy on a stock that starts to go up and is working is always automatic. If the pivot buy point is $50 and it goes up 2.5%, 3%, I'm going to automatically follow up and buy, because I don't know which one's going to wind up being my biggest stock, but the market will slowly and gradually tell me over a number of weeks. And so I make a second buy, and now I get a chance somewhere to make a third buy. And now
thinking, automatic.
Yeah, and the market tells you what's working and what isn't, and you just have to be able to handle it right.
Okay, so let's move on. That was great. Okay, we talked about that. Focus on the percent from the pivot. That's simply that exact spot. And then Bill talking about pyramiding in. The second purchase is 2% above that spot where you went in on the first purchase, and it's a smaller amount on the second purchase. Let's keep going. Okay.
There's your buy point, and you buy maybe up 5% from that. So it's $100. Well, 5% would be $5, so you could go to 105. And beyond that, you're sort of chasing the stock.
And that's what we've got here. Actually, Bill, we've got pattern recognition and MarketSmith turned on. And so the blue zone is that 5% for any newcomers. And we are drawing the cup and handle, and then the pivot are the two dashed lines at the top. And then, of course, it breaks through the pivot, and you can make these purchases Bill's describing within the blue zone.
In order to handle this system correctly, you've got to be watching and anticipating that this stock looks like it's building the cup with a handle, and here's my buy point. And let's say you're 1.5 points away from it. I would not try to buy early before it breaks out, because sometimes it never breaks out. Yeah. I would wait, and when it hits that point, you got to be buying it.
Yeah, I've done that a few times.
So, yeah, you can't play cute with it and think, oh, I'm going to get an edge here. I'm going to get a couple points cheaper, because the stock may not work.
Right. I've had it happen where it looks like it's going, and I start buying it, and all of a sudden it just runs out of steam just before the pivot, and it comes back in on you.
So here's an important thing. Your objective is not to buy at the cheapest price. It's to buy at the exact right price where you have the highest probability of the stock now going up. And that is this buy point that we show there. When you have the handle in the cup has built, and those things are built because professionals are accumulating the stock, and that's why it forms these different patterns.
Even you pros that are listening to us today, still, this is a great reminder. It's one of those basic fundamentals that we always have to hear every now and then. All right, so moving on, very fast, don't chase beyond the pivot. Sometimes you get away with it for a day or two, but it always seems like 3 or 4 or 5 days later, the stock comes down and it gets you. And so remember that blue zone on pattern recognition. You do not want to get beyond that. We talked about this already. Every first purchase must be the same amount, because you don't know at that early stage which ones will become the bigger producers for you, the faster horses, and which ones aren't. So you want an equal amount, and that's dollars, not shares. Okay, and you mentioned this already also. So the better stocks you have, they come up, they will at some point pull back to a logical support, or most likely a moving average, probably the 50-day moving average. That's where institutions will pick up stocks, add shares to their favorite positions. But we look for that to add to our favorite positions also.
Well, I guess the bottom line answer is you're not going to be right all the time, and when you buy it correct, you want to automatically follow up, and then you may get other opportunities to add to the stock. And as I look back in the past, I would get huge positions in a stock, but never just starting. But if that stock breaks out and it goes up and does what it should, and it forms another base that's exactly right, I might be able to add some more. And now this sounds a little bit scary, but if you're experienced enough, you may wind up with 50% in one stock.
given time.
Given time. But you never would go in and buy it right off the bat like that. But I know I started in Apple very, very early, and it just built base after base after base after base. And so you would wind up with a little bit more of that than something else. In other words, you weren't limited to just 5 or 10%, or and the way we would invest, we would probably wind up with more than 20% in the stock that just keeps on giving us more buying areas.
That, and of course the appreciation, it becomes a higher percentage in the portfolio.
Yes.
So everything's working in your favor. Okay. Now, this is kind of where the rubber hits the road. We want to try to pick your brain on how do you identify that potential leader, the A stock versus a B that you'll just take your 20% kind of thing. So let's talk about key characteristics.
Well, one is that when you buy, thinking you've got this cup with a handle and here's a perfect buy point, you immediately have a profit. In other words, the pivot is 50, and the stock winds up at 51.5 or 52. That is one hint. The earnings, you want to get stocks that have big earnings, not a 5, 10, 12% increase. 20% is my minimum, but what I'm really looking for is somebody whose earnings are up 50, 100%. In fact, I'll give you a little, I'm not going to mention any stocks, but I own 4 stocks right now, and the last quarter in one was up 126%, another one was up 79%, another one was up 52%, and the weakest one was up 18%. And that was because the prior one was up 20-something, and they came in a little bit lower. But I want big earnings, and I want to see some acceleration at some point. So it's not so much PE ratios and supposed values and getting in cheap. It's buying the right thing that is showing all the data, and you're buying the biggest earnings that are out there. I don't pay that much attention to PE ratios.
I remember one time when I asked you, again, long ago, but I had asked you, well, how big? What do you like? And you immediately said, the bigger, the better. There's no ceiling. I like 900% more than 800%, 800% more than 500%. And
well, believe it or not, there are some stocks out there right now whose earnings in the last quarter are up over 100%. Now, that's better than somebody that's up 50%, and 50% is better than somebody that's only up 12%. In fact, I won't buy somebody that's up 12%. Why should I? Because you've got choices out there of thousands of stocks, and you want to find the ones that have the biggest possibility of really being a leader.
You always want the very best at that time.
And it isn't the lowest PE. It's one that has the biggest earnings and a great product, and the stock's acting the way it should be acting.
Now, we don't have time to get into all the proprietary ratings, and you've spent 50 years perfecting them and crafting them. But what's maybe your favorite one or two, and just why you built those ratings, and they're obviously time savers, but how do you use them?
Well, I look at the basics. In other words, how much are the earnings up in the current quarter? And the bigger the percent, the better. Then I'm going to look at several quarters and see, is it showing some acceleration? In other words, one quarter was up 15%, now this up 25, now one's up 40. So that's the key thing I'm looking at. And then I want the sales too. I don't want to have earnings up and sales are only up 2 or 3%. I think that the earning power really comes from product really selling, and so I want both those things. And then I'll look at the return on equity. If the return on equity is 6%, that will bother me, because I want a return on equity that's 20, 25% or higher. In fact, I would go back and see my biggest winners, say, over the years. I remember would have, say, a 50% return on equity. We're going to show everyone that in just a moment. That's a great story. So on the proprietary ratings, it's safe to say that you tend to have stocks with an EPS and RS in the 90s and a composite rating in the 90s?
Yes.
Okay. The precise entry we've talked about. Okay. This is a big, big point that helps with true conviction. You know, every time we buy a stock, doesn't it feel like you strap yourself to a hand grenade and you've got volatility and now you've got some valuable shares and the institutions want them and they kick you around? How do you hang in there through that kind of punishment? Well, how well do you know the story? You want to talk about the innovation point?
Well, there are two things here. Excuse me. You got to buy it right to start with. And if you buy it right, you've got a cushion, and it has a much better chance of working. And you should have checked all your basics. What are the earnings? What are the sales? What's the product? And you understand there is a story. It's a simple story. They've got this new product, and it's really selling. And it is superior to something else. It's either faster or cheaper or something is unique about it. And the more you know about the company, the better off you are. Most of my real big winners have been stocks that I went in the store and it was a retailer that say Pick and Save, and I knew that their business was always active, and I used to count cars in the parking lot. They'd have 50 cars in the parking lot, always, at least. And so by seeing the product and understanding it, you start to have a big conviction. I bought a stock years ago that was, I guess, the first one to have an oral contraceptive pill. And the earnings were up 150, 200%.
Before you bought it?
Yeah.
Mm-hmm.
Those kind of things of some product that can have a wide application and it's selling well and the earnings are booming and everything, it helps to know and understand what is this product and why is it so unique, and then the earnings have to be accompanying it. So that gives you your conviction if you really know the story. I owned Pick and Save for 7 years, and I don't own very many stocks for 7 years.
Well, they also, you told me that every quarter they just kept pumping out great earnings numbers.
That was it, sure. And I could walk in the stores because they had several in Los Angeles, and I could figure out, okay, they've got 20 stores, and now they could have actually 40 if you figured out how many they could put in Oregon and Arizona and everything else. So the more you know about it, and I always liked retail and items like that because you can go in and see the things, and the retailers build their earnings by the rate at which they're opening new stores. And if you get a retailer that's got something unique and they've only got 5 stores or 10 stores, you're in very early, and that was the way it was, I think, with Pick and Save, because we're here in L.A., and I think they had 3 stores to start with.
Same for Price Club. Actually, I think we've mentioned in a previous webinar that a key metric for the growth of a retail stock is store openings per year.
Yeah. I know it's how many stores you have now. Let's say you have 10 or you have 100. And how many are you opening now? If you have 10 and you're opening 5, that's pretty good. If you have 100 and you're opening 20, that's not too bad. But if you have 100 and you're opening 2 or 3, well, that doesn't mean much. That's where they get the earnings growth.
Okay, so let's keep going. And just very fast, this is something that